Welcome back to the ARMR report. We're now on the other side of episode 1. And the ARMR report is a report that focuses on stock market investing through the Millennial lens. ARMR stands for Algorithmic Risk Management Research. Now, I like to say this isn't your dad's stock market. It's certainly not your granddad's. It's a millennial market. Everything changed after 2008. And you need millennial tools if you want to execute correctly and increase your net worth while protecting it from serious capital erosion during downturns. And what we do on this trading desk every day is we focus on traditional fundamental analysis of trends and of companies, but we focus on the interaction between that and millennial execution tools. And so what I do in our podcast every day at 12 o'clock during trading hours is I share with you information directly off our trading desk while we're doing it. We're managing real capital, my own capital and that of investors we work with, all of it done through interactive brokers. Accounts simply linked to our tracking portfolios and immediately hook into the power of algorithms. And what I'm doing on these videos now is I'm going to take things that we discuss on our podcast at 12 o'clock and really try to give you the proverbial picture that's worth 1,000 words. And so I thought I'd start with our first video. This is the screen capture part of our first ARMR report, if you will, from YouTube. So I wanted to share with you the top 4 algorithms for the big indexes that really generate all of our decision-making processes on our desk. We use the exchange-traded funds of the top 4 algorithms, or excuse me, the top 4 ETFs of the big indexes. The S&P SPY, the Dow DIA, the triple Qs, QQQ, NASDAQ 100, and the small cap index. This is the engine that drives all of our decision-making process. And when we talk about it on our podcasts, we talk about whether or not these algorithms are telling us to have risk on in the portfolio or risk off. So this is how you, as an investor, can immediately start using this information to help you manage your own portfolio. I certainly don't know what your risk tolerance is, and if you need more advice, you'd want to contact us. But if you want to just use this tool immediately to start protecting your net worth and still using the net worth to grow during the right times in the market, this tool ought to help you. And so step 1, what you're looking at on the screen capture is a lot of lines and a lot of noise. So let me try to break it down for you. You're looking at a chart, a price chart, the 60-minute price chart of the S&P, SPY. You can see that in the top part of the screen right here. My cursor is, hopefully you can see that. SPY 60 minutes. Each bar is 60 minutes. We're going all the way back to May. I wanted you to see how this process evolves. Here's the buy point that happened back in July. The very nice run-up. We book some profits along the way. We raise our stop. Now, how we book profits and what we do in an individual portfolio is different for each portfolio. We have 3 tracking portfolios. One's conservative, one's aggressive, and one's, balanced. And so that we will take this algorithm and say, okay, here's a point where the algorithm says we should be reducing exposure. And we look at a portfolio and determine how much exposure do we want to reduce. If it's an aggressive portfolio, we may not reduce a lot. We might just take 10% off the table. If it's a conservative portfolio, maybe 50. We have trailed stops. Now, when the algorithm goes to 100% cash after a nice run-up from July, that tells us it's time to really get defensive. Now it's drilled down. You can see the dates in here where the final piece was executed. Okay? That's on October 10th on the S&P. So by October 10th on the S&P, the algorithm said, you got to be out of Dodge. We already booked some profits on the way up, but at this point, this is the last piece, and it's time to raise that last bit of cash. So whatever, as an investor that you are, when you look at this information, you've got to determine, let's just say you want to try to be a long-term buyer and hold investor. I call it buy and hope because it's a very dangerous prospect and one fraught with peril. But I digress. If you want to be that type of investor and you only want to carry, let's say, 25% cash at any given time, then that's the time to finish off your cash position. You might have been raising some cash throughout the months of, let's see, somewhere in here. You're making new highs. Maybe you raise a little cash back here at the end of July. Then you're letting the thing run. When you get that drop down by October 10th, you're definitely 25% cash. You're holding that at the very least. For our real conservative portfolio, we're 100% cash at that point. Not just because of that, but because, and I'm going to move over to the other indexes in a minute, all of our indexes were telling us to be in cash at that point. So we use the index itself and we use its interaction with other indices to tell us what we want to do from here. We use these big indexes first to manage our capital, and then we expand into groups that are specifically geared towards certain trends, and then we drill down further and own stocks that benefit from those trends. But it all starts from here. Now, I've also been saying on the podcast, which you can find on our website, rosenthalcapital.com. Scroll down to the bottom, you'll see all of our podcasts. I've been saying for quite some time now that the danger in the market occurs, the most dangerous time to own stocks is when the 50 and the 200-day moving averages are in downtrends. This white rectangle is highlighting that period of time. So I mentioned again on today's podcast and on last week's podcast, Friday's podcast, I think, I mentioned that we were, for the first time in a long time, putting market shorts out. I only have an interest in shorting the markets when the 50 and the 200-day are in downtrends together. That's where all the money is made historically, on the short side. Can you make some money over, a couple weeks here or there where the market has a correction? Sure. But I find it's better to use those short-term corrections to prepare for the next buying opportunity instead of getting caught up in the negativity of short selling. Short selling is very dangerous. I don't recommend it for most investors. But if there's ever a time to be short, it's when the 50 and the 200-day are going down together. Now, everybody talks about the death cross, and we'll get to that in a minute. That's when the 50 crosses below the 200-day. But I submit to you that if everybody already knows about the death cross, it's a little bit too late when it comes to protecting assets. We have to derive our own information on our trading desk. I've been doing this 30 years. I can't believe it, but it's actually 30 years. Started in 1988. I've gathered a lot of information over those years. I'm sharing some of it with you today. The time to start setting up your short is when the 50 and the 200-day are in downtrends. So when we had that most recent risk-on entry signal in the S&P here, market ran up. That green line is our first target. We took some profits there. When it reversed and took out the position at a raised stop, that's when we start shorting. Because that's how we know that this 50 and 200-day downtrend pressure is overwhelming the market, and the risk isn't worth the reward anymore on the long side. and that statistical equation flips and starts to favor the short side. And as I like to say on our podcast, we're always trying to get on the right side of statistics and probability. That's what we're trying to do. If we could be on the right side of statistics and probability over and over and over again, over time, we're going to be very successful. Now let's skip to the other indexes. You could take a look at the Dow. Same situation, albeit the Dow exited its trade from mid-August, which was a nice run here. We had a nice run from the July period, trailed, stopped out, got back in a couple days later, ran it up again, trailed, stopped out again, and that was an outstanding exit. As you can see, this part right here, we exit that trade right at the top. Trailed, stop, exit, right at the top, the market craters. Okay, and that was on the 10th as well. So we were exiting the S&P, we were exiting the Dow. Again, we get back into the Dow trade here on a break back above the 200-day moving average. It runs up and fails. We have two exits in short order. It gives us an opportunity. Now, I'm not shorting the Dow in our portfolio. We're using the S&P, the NASDAQ 100, which I'll flip to now. You can see that the NASDAQ 100, and this is very important, going back to the 5th of October, our algorithms told us to exit our positions in big cap tech stocks. Right there is the exit point. Time to get out of big cap technology stocks. Those stocks have been absolutely destroyed ever since that day. This is the NASDAQ 100 showing you its decline from the 180 area down to the 162 area. But individual stocks that are in the triple Qs, Facebook, Google, Amazon, Apple, Nvidia, the list goes on. These stocks are down in bear market territory now. And this algorithm saved us a lot of money, protected our assets. That's why I say a picture's worth 1,000 words, and I'm starting to do videos now so you can see it. And to round out the top four, I wanted to show you the original exit. I keep saying this on the podcast for all you podcast listeners now viewing this. You know I've been saying repeatedly that we were begging you to get out of the most risky part of your portfolio on the 24th, the morning of the 24th of September. 24th of September. There's your risk off exit right there. Get out of small cap stocks. And of course, October, they collapsed. That's how powerful algorithms can be. It can help you protect your capital. That's step one. So I hope that's been helpful tonight. And I look forward to chatting with you again the next time we have something worthwhile talking about. In the meantime, please look us up on our website, rosenthalcapital.com, and join us every day, 12 o'clock, during trading hours, to find out how these algorithms are changing and how it affects our portfolio. Have a good night.